In today's video, we're going to talk about pass-through entities. What are pass-through entities, the pros and cons of pass-through entities, and whether or not it's the right business structure for you. So a pass-through entity is a business structure where all the income, deductions, and the credits pass through from the business into the individual owner's tax return, and the individual owner pays either the income, the loss, or any credits associated with that pass-through entity. As a result, the business itself does not pay federal income tax because all that income is passed through to the owners of that business. Now, this structure helps avoid double taxation, which is very common among C corporations. So when a C corporation makes a profit, it has to pay tax on that profit. And then when that C corporation distributes their profits to its owners, then the owners again have to pay tax on that profit as well. So it's double taxed. But a pass-through entity avoids that double taxation because all that income is passed through to the owners of the entity, and then the owners of the entity pay their tax on it. Now, it's important to note that even though on the federal level, pass-through entities do not pay income tax, some states such as California, New Jersey, they impose taxes on the entity, even though it's a pass-through entity. So for example, in California, depending on whether if it's an LLC or an S corporation, it'll impose a certain, either a tax, a minimum tax, or an LLC fee on that corporation or that LLC. Whereas on a federal level, there's no tax implication. There are different types of pass-through entities. There's a sole proprietorship, a partnership, an LLC, or an S corporation. A sole proprietorship is the simplest form of pass-through entity because it's actually not a separate legal entity. All the income and expenses that a sole proprietor earns is listed on their Schedule C on their personal tax return, and they pay tax on that. A partnership is the next type of pass-through entity. And a partnership is essentially when there's two or more individuals that come together to form a partnership, and they file what's known as a 1065 form with the IRS. That's the tax return that a partnership files. And when the 1065 is filed, each of the partners receive what's known as a K1. That K1 shows that partner's income, deductions, separately stated items, any credits that's applicable to their partnership, and they pay tax on that on their personal income tax return. A limited liability company is essentially a hybrid type of entity because a limited liability company, also known as an LLC, is a pass-through entity, but a LLC can either be taxed as an S Corp or a C Corp. So if an LLC is taxed as a C Corp, then it's not a pass-through entity. But if an LLC is taxed as an S Corp, a partnership, or a single member LLC, then it is considered a pass-through entity. And in that case, all the income is reported on the individual owners of that pass-through entity, and they pay tax. But if it's an LLC taxed as a C Corp, then there is going to be double taxation, and it's not considered a pass-through entity. An S corporation is also another form of a pass-through entity, but in order to be an S corporation, you have to meet certain guidelines, very strict guidelines on who is eligible to be an S corporation. But an S corporation is a pass-through entity because all the owners of the S corporation will also receive a K1, just like in a partnership. And then the owners of that S corporation will receive that K1. They'll report their income or loss or any special allocations to them from that K1 on their personal tax return. So let's take a very simplistic example. If we have an S corporation where you have two shareholders, each one of them are 50% owners of that S corporation, and the S corporation earns $100,000 of net profit in that year. At the end of the year, each owner of that S corporation will receive a K1 that will show $50,000 of net income applicable to that S corporation. And each shareholder will take that K1 and will show $50,000 of income from their investment in the S corporation on their personal tax return. So there are several advantages to having a pass-through entity. The first one is that it avoids a double taxation. As I mentioned earlier, a pass-through entity does not pay tax on a federal level. So an S corporation, a partnership, an LLC not taxed as a C Corp does not pay federal tax. Now, it might pay state tax, but it does avoid that federal taxation. Also, it's very simple. A pass-through entity is relatively simple to set up, especially if you have like a single member LLC where there's very minimal paperwork involved, but you can still have a pass-through entity through the single member LLC. Also, with with this pass-through entity, you have loss deductions that flow through to the individual owners. So for example, if you have a partnership, which is a pass-through entity, and that partnership has a loss, and you're a member of that partnership, you're a partner, that loss will flow through to you, and you may be able to deduct it on your taxes. And I say you may be able to deduct it on your taxes because there are certain limitations, such as basis limitations, at-risk limitations, that will limit you on being able to deduct that loss. The other benefit pass-through entity is that you're able to take advantage of what's known as a QBI deduction, also known as a Section 199A deduction. If you want to know more about the QBI 199A deduction, then look at another video I did really deeper into what the QBI deduction is. But essentially, if you're a pass-through entity, you get to benefit from this generous 20% QBI deduction that's not available to C corporations. Now, obviously, pass-through entities do have some disadvantages as well, one of which is the self-employment tax. If you are an LLC, a single member LLC, or a partnership, or an LLC tax as a partnership, then the income, your portion of your income that's reported on your K-1 is subject to self-employment tax, which is currently at 15.3%. Now, if you're an S corporation, one of the benefits of the S corporation is that your flow through on your K-1 is not subject to self-employment tax. So that's a big benefit of the S corporation, even though it is a pass-through entity. Another disadvantage of a pass-through entity is limited fringe benefits, especially if you're a 2% or more shareholder. So if you're a 2% or more shareholder in a pass-through entity such as an S corporation, and you have health insurance premiums paid or life insurance premiums paid, those things are not going to be deductible as they would if you're not a 2% shareholder. Another disadvantage of a pass-through entity is that there's much more complexity with the allocations, especially if you have multiple partners, multiple shareholders. You need to determine which of those partners have income or expenses allocable to them. So bookkeeping and the allocation of that becomes much more complicated the more shareholders or more partners that you have in a pass-through entity. Also, another disadvantage of a pass-through entity is as you have more shareholders or partners, there's more opportunities for disagreements, complexities, legal disputes. So all those things come into play when you have more members or shareholders in a partnership or a pass-through entity. That doesn't come into play when you're a C corporation and you're not a pass-through entity. Because, for example, if you're a shareholder of Google and another shareholder of Google, it really has minimal impact on you as another shareholder. But if you are in a pass-through entity, then it will definitely have an impact on you. I mentioned earlier on how some states impose taxes on pass-through entities, even though on a federal level, a pass-through entity does not have tax implications. So that's another disadvantage of a pass-through entity, is that some states impose taxation on those pass-through entities. Another big disadvantage of a pass-through entity is that retained earnings are taxed, even if they're not distributed. So for example, in an S corporation, let's assume the S corporation earns $100,000 of net profit, and there are two shareholders, each own 50% of that S corporation, but the S corporation decides that we're not going to distribute that $100,000 of net profit. We're going to keep it and reinvest it in the business. Even though that S corporation reinvests that money and doesn't distribute it to the shareholders, those shareholders will still have to report their 50% share of that $100,000 of net profit and pay tax on it, even though they didn't actually receive it. So that's a big disadvantage of a pass-through entity, is that the retained earnings, even if they're retained by the corporation, are still taxable to the owners of that S corporation. Pass-through entities are also subject to at-risk and passive activity loss limitations that don't apply on C corporations or non-pass-through entities. So this is yet another disadvantage of a pass-through entity. And I'm going to have a separate video where I talk about at-risk and passive activity loss limitations. And lastly, another big disadvantage of a pass-through entity is that it's less prestigious for companies that are interested in becoming IPOs or going IPO, which is initial public offering, or if you're looking to raise capital by venture capital or private equity. Usually those types of entity structures are C corporations that are subject to double tax, but they are more appealing to outside investors such as private equity or venture capital funds. So in closing, a final thought is when you're setting up your entity, you want to make sure that you set up the proper type of entity and whether or not a pass-through entity is the right fit for you, or if you want to do a C corporation that's not pass-through and you get double taxation, but you want to make sure that you've got the right type of entity that is applicable for the type of business that you're going to be running.